I think we're getting everybody online here. We'll go ahead and get started and then kind of kick it off to you, Phil. So,
Cool. Yeah.
um, hey, welcome everybody. I am Andrew Paoni with Sikich Financial, and thank you for joining us today for the 2026 Market Outlook and a recap of 2025. We're honored to have Phil Blancato, Chief Market Strategist of Osaic, share his insights and expertise today. We started off 2025 on a positive note before the start of the tariff war and Liberation Day, and subsequently the market dropped 20%, and most economists were predicting doom and gloom for the year. Those investors who held on throughout the year and the market drop owned a diversified portfolio were richly rewarded. So today we want to look back on 2025 and more importantly, look ahead to see what Phil had in his crystal ball for 2026 and see what we might expect to hold for the year. Before we get started, I want to highlight the Sikich Wealth Management team. Sikich Financial is a registered investment advisor with $1.8 billion in assets under management. We're a full service wealth management firm with financial planning, asset management, insurance services, and retirement plan services. So let me introduce Wesley Wahman, who's a financial advisor with us, and Wes will go over some quick housekeeping items, and then we'll get started and turn it over to Phil. So thank you.
Thanks everyone for joining us today. Just to give you a heads up, today's webinar is being recorded. You will receive an email with an on-demand version of it. And if you have questions, use the question feature, question mark feature on your panel. And during the course of our presentation today, there will be 3 pop-up questions. Those are used to track attendance as well as CBE credit for those that are looking for it. CBE credit, you need to answer all 3 questions, so stay on for the full call. On that note, I turn things over to the Think Advisor Luminary Award-winning Chief Investment Officer of 2025, Phil Blancato.
Thank you for that. I appreciate it. It was an honor to win the award, and honestly, I'm flattered. So it's very nice you mentioned that. Well, everybody,
do we have Phil? I'm sorry, Wesley. Do you have a poll question first? Like I think we may.
I think we do. I think we will start off with a poll question here.
Okay,
so,
yeah, let's do that. Cool.
Yeah. This is for the audience. There's no right or wrong answer for any of these. They're all multiple choice. But where do you think the S&P 500 index will be in 2026? We'll give people 30 seconds or so to get their answers in there, and that kind of gives you a launch pad, Phil.
I think we've got our answer. I like our answer. Well, we got a few negatives. Okay, I can respect that.
All right, so I think that kind of wraps up the time there. We've got positive returns for 87% of the audience. So greater than 10 is 25%. Between 1 and 10, 62%. 3% think it's going to be unchanged, and then 11% think we're going to have negative returns in 2026.
And I actually, I'd love to use this for a second, just as a jumping off point, if that's okay, Wes, before we go to the next question.
Yeah.
You know, first off, I agree with those who are in that 1 to 10% category. When you look at history of markets, oddly enough, the last 10 years we've had an average return above 14% for the S&P 500, just about 14. The last 20, it's at almost 11.5 because the last few years have skewed it to the upside. But historically, it's closer to 8. And really, if you take out this kind of anomaly of the last 10 years, it's really closer to just under 8. And why I mention that is because I think you want to look at 2025 as going back to normal, or what's old is new again. That diversification should actually work again. It hasn't worked in a long time. When you think about returns of equities, it would make sense if we go back to a normalized equity cycle. And the reason being that from a valuation standpoint, the S&P 500 is not inexpensive. Certainly, you have this opportunity of this AI euphoria and the broadening out of the market. Look at the first few days of the year as an example. But having corrections throughout the year based on economic cycles of 3 or 4 of a 5% a year, or 1 of 10% makes a lot of sense to us. And the reason why I think going back to average, to your point here, those who are in that 98 of you, is because when you look at history of returns, that's your starting point. But your end point is you would continue to need exceptional earnings growth to justify valuations. And for those of you who are in the 40 range, the above 10%, here's where I want you, and we're going to do this in the presentation a bit, but I want you to think of the environment as an experiment. And there's one of 2 ways this experiment goes. That Does the United States become this coiled spring that kind of unleashes? And it's because of the ability to immediately deduct costs of any new costs of a corporation that are building a new factory or investing in their business. It's a huge piece of the bill. Do we get a significant tailwind by the consumer because of lower taxes? Do we get a lower regulatory environment, which actually drives lending a bit higher? Do we continue to see energy prices stay below $60 a barrel, specifically oil, and to a lesser degree, nat gas? How many of you appreciated paying $2.50 a gallon for gasoline, depending on where you live? I paid $1.75 in Texas the other day. That's quite incredible. I paid this since I was a kid. That is an impact. So is this coiled spring moment that the U.S. grows at 3% GDP, which then translates to significant earnings growth, which then translates to higher earnings, wages growth, and suddenly you in that 10% above category are right, because now you're justifying valuations based on earnings growth. Or is it the other side, those of you who are in that negative return? The reason why the negative return is that this was a concentrated rally. You look at the last 3 years, 60% of the returns 3 years ago were AI, 52% 2 years ago, 43% last year, all AI related stocks. And at that, we know the Mag 7 story. And in fairness, the Mag 7 were not in the top 10 this year. Only more than one, call it two, were in the top 10 of returns for the S&P, but still a very narrow market. At the end of the day, there was still the bulk of returns coming from a handful of stocks. And for those who are in that negative category, it's that the AI trade, the bloom comes off the rose. And the reason why it would is you don't see increased productivity from AI. Although my favorite story is about Flippy the Fryer. Wes is probably sick of me telling this story. I think it's exemplary. If you go into a White Castle, and I bet a few people on this call have been to a White Castle, probably at 1 o'clock in the morning when maybe they had a little too much of something, and you go to order French fries, there's now, believe it or not, across the globe and in the United States, thousands of AI arms, robotic arms that are frying French fries in Jack in the Box in White Castle. They have fried in excess of 4 million baskets of French fries in 2025. What does that do for White Castle? Well, they didn't pay a person to do it. The person didn't show up, didn't call in sick, didn't pay benefits, and didn't pay taxes on it. That's enhanced productivity. We're in living color. And whether you're using Zod or Jump or whatever for your own stuff, you're seeing it every day. But if in fact we don't see some revenue return on the nearly $3 trillion spent on AI, those in the negative category would be right. That we would have that negative moment where we would see a sell-off in some of those big names. NVIDIA's got $300 billion sitting in cash. They don't know how to do it, so they keep buying things because they got to spend it. So if some of this stuff becomes a fool's errand, and we get that negative market, and in a narrow market, that's very common when you get a significant sell-off because of the narrowness, the other stocks can't support it. Well, then you'd have that scenario. And really what it all comes down to for this model, the reason why I'm in the 1 to 10 category, I do think 2025 was exemplary earnings growth. Every single quarter we beat expectations. When usually high single digits or low double digits, beat it. And not just in large growth, you beat it just about everywhere. And that's why the market held up and held on. Forget about the international trade for a minute. I don't want to get into that just yet. But my point, why the 1 to 10? Because valuations are rich, even though I think revenue hangs on. And I would go one further. When you think about the state of the U.S. economy, it comes down to really two things. Does the job market hold on? And as of now, it seems like it is. ADP this morning, which is a really good number actually, suggested that, yeah, we're probably okay. Lower immigration, lower jobs added per month. So the narrative we grew up with, 100,000 jobs added per month is the norm. It's probably the new norm is probably 50. Somebody retires, somebody gets replaced. If that's where we end up in the labor market, there's our 1 to 10. If that number breaks down, and here's what I want you to think about, write this down, everybody, because if you want to, first takeaway for today. If weekly jobless claims push above 260,000 and continuing claims break above 2 million, really 2.1 million, then the folks in that 11% negative return category, those 17 are going to be right. It's just that simple. The other one, really easy. If inflation reverses. We haven't gotten into tariffs yet, but if there's any significant reversal in inflation, specifically because of whether it's tariffs or the plethora of other reasons that could happen, tighter labor market, higher wages as an example, too many U.S. Treasury bonds out there in the world, no one wants them, so yields have to push higher, which is a stagflation. If yields stay high and you get limited growth or modestly flat inflation but higher, that's stagflation. So those scenarios are possible. I don't think probable, but possible, and that would be the second poison. points, weekly claims, continuing claims, and inflation. That's all you really need to keep an eye on. And inflation between 275 and 3, no big deal. Pushing higher to 3.25 to 350, big deal. And that's where you want to set your line in the sand. So what do you do?
We did have one person ask, is the White Castle robot that fries French fries AI or just a robot mechanical system?
That's a great question. Initially, the robot was not an AI, was not managed by AI. They needed to bring AI into it so it knew when to take the fries out, what was the right temperature, when to drop it in the basket, and then how much salt to add. It's pretty cool. Go on Google right now, Flippy the Fryer, and watch it in living color. It's pretty wicked. So
check it out.
And the video is cool. If you want to use it for your clients as an example of how AI is going to eliminate the first rung of jobs, there it is in living. Oh, that's the thing. Maybe you saw one of the presentations I've given. The elimination of lower level labor jobs has been going on since 1970. And really, if you go back to Henry Ford's days, you could argue there's always been the elimination of that first rung of labor that we have trouble finding people for. And if you look at 42% of the U.S. workforce in 1970 was that lower rung. Today it's 23, probably going to 15. You're not going to eliminate the guy who's probably picking up a garbage can, unfortunately, or gal. But certainly there is that necessity to fill the fryer. Nobody wants that frying job. The need was that who wants to fry French fries at 1 o'clock in the morning, and you get burnt, and you got drunk people walking on White Castle, and the job doesn't pay very well. Well, there you go. It's the AI, I think, fills that labor demand for folks that we can't hire today. Look at Caterpillar. It's a great example. Caterpillar is converting from a traditional brick and mortar manufacturing company to a cutting edge AI company. They're powering data centers. Their autonomous tractors will then go into a field and do the picking and planting without a body. And that's all AI. They'll have $30 billion. I'm not recommending stock. I'm just quoting some stats. They'll have $30 billion in just pure revenue, money spent at Caterpillar from companies that need enhancements to their AI supply chain. Mining specifically. That's pretty cool. So
awesome. My
point is there is this productivity coming from AI. And I do think that to those folks who got that one wrong, I think that I'm sorry, not wrong. One is that the market's going to sell off. It would happen if we don't get the productivity from AI. All right, next question. This is fun.
As we stay on that AI theme, this was a question that was submitted before our meeting today. It says, can AI improve productivity enough that debt will lower enough compared to the GDP to be at a healthy level?
So debt to GDP ratio in the United States right now is 5.4%. Put it in a different way, we're spending 1.8 trillion more than we make. It's your biggest black swan we have. I'm going to throw another coal and another log on the fire. Social Security. You are 4 years away, maybe 5, from the federal government have to supplement the amount of money that's in Social Security in order to keep the current paychecks where they're at, the current Social Security checks where they're at. That's not going to happen. We can't afford it. We can't have a scenario where the United States has to add more money. Because remember, Social Security is based on payroll tax and employee money going into a trust fund, which was never invested other than anything but treasuries, and then ships back out. But unfortunately, and by the way, I would agree, if George Bush had let us privatize Social Security, had let everyone have their own individual Social Security account that they could invest, we wouldn't be in this situation. Anyway, you're faced with the age of just Social Security from not being able to take it at 62 to 65, that would fix it. Just bring it up by 3 years from new people coming in. You adjust it by having more people. They basically say, okay, the cap is 158 today. Make it 200, 225. That would help it. My point is, your issue is you look at the size of the national debt today, and you look at what we're going to owe in Social Security combined. That's your black swan issue. And from a debt to GDP ratio, whether it's 5.4, which by the way, we were worse at other times. We're a bit better this year. We have no choice but to get this under control. And the reason why is because you're spending, think of this, you're spending 3 times the amount of money on Social Security than you are on national defense, 1 time more on interest rate payments than you are on national defense. This scenario, this debt to GDP, is the biggest issue we have. And I'll take you a different way. Continuing to increase the size of the debt without the revenue to match it, you run out of people to buy treasury bonds. Today, 70% are owned by Americans, the other by the rest of the world. But when the dollar weakens, they're going to buy their own debt because they get a better yield on it. So that's a problem, unless they're buying in dollars, but they're not. They're taking their dollars, and so that creates a different imbalance. So now you have a scenario where you may get less foreign investors. Look at German bonds increasing right now, when they can invest in their own economy, which they prefer rather than U.S. economy, depending on what the spread is. So my point is, far and away, Wes, the one thing that keeps me up away, and it's not a day-to-day thing, but it would mean that the United States has to look like France or Europe or Japan, that we're spending the bulk of our revenue just on our interest payments, which means limited growth, which means you want a very different scenario. I jokingly call it Dante's Inferno, level 1 of hell. Because if you don't get you got to get your math right soon, you go into level 2, and you don't want to end up on level 6, because then you get eaten by the devil. That's bad.
Awesome. Thanks, Phil. We'll let you go. Well, when we save some of the questions to the end too, so let you kind of keep on your thoughts. But yeah, I think increased taxation or lower spending, and nobody wants to do either. So
increased taxation. I prefer greater revenue over increased taxation, but we can have
correct,
that.
yeah.
Maybe a little bit of both, in fairness.
Yeah.
All right. I could jump in with just some topical ideas. I love
Sure.
questions. By the way, please, folks, fire off questions. I want to do a quick 2025 look back, 2026 forecast for you all. When we look back at 25, I think the things that were the surprise of 25 was that interest rates really did remain fairly elevated. I mean, they came down a bit. We saw a couple of cuts in there, but nowhere near what the market expected. 1.5%, 2% cuts. We over the course we've seen the numbers come down, but not really as high as we thought the Fed would cut, which meant, more importantly, that the 10-year U.S. Treasury really did kind of get anchored in that 410 to 430 range. So surprisingly, we didn't see the 10-year break below 4 other than for a blink of an eye. And what it meant for your bond portfolios, if you did what we recommended, which was go take your duration around 6 years plus, you did really well, because you got enough price appreciation, you got one hell of a yield. So in hindsight, the theme of 25 for me, yeah, I get it. International markets did well, and certainly U.S. equities did fine, did great, but the bond market kicked ass. When's the last time you all got a 7.5% to 8% rate of return in your bond portfolio? So your risk-free rate, especially for treasuries, is basically zero. I would argue it's zero. And you did really pretty well. You did 5 or better in that portfolio. So the one theme of 25 that surprisingly to me has not been talked about nearly enough is that bonds are great again. And I would think you want to look at bonds as being a substantive part of your portfolio because of the yield they're providing and the potential for some price appreciation. Where's the 10-year go this year? Well, if we do get enhanced AI productivity and we do get a GDP hanging in there at 3%, the 10-year probably doesn't fall much below 4, maybe 395, 390. The front end of the curve, assuming inflation modestly grinds down to 250, 225 on PCE. I don't care about CPI, and stays there for a quarter or two. You might get 2 cuts next year. I know we need to get a new Fed chair. We need to get new Fed governors. I get that. I understand some of that. But the reality is you got to still be data dependent. And the fact of the matter is, I think we have a scenario where rates will come down, I think, a bit, but I wouldn't have high expectations. So surprise 1 was interest rates. Surprise 2, the housing market. And we thought the housing market would stay tight, that CLOs, that mortgage backs would be a great place to be, and it turned out to be a great place to be. When you look at a housing affordability, it's the 3rd worst in American history. Average salary of around $80,000 a year, average price of a home of $430,000 a year. Divide those two together, it's nearly the worst in history. I just saw a headline this morning, I didn't read about it, that the president wants to stop big corporations from buying large groups of homes to try and make up for the lack of homes being built. Whatever. I don't think politics and economics mix. Not touching that one. But we have a scenario where you've underbuilt homes in the United States for a long time. You're building 1.2, 1.3 million a year. You should be building 2.5. To be provocative for a moment, I'd bet anybody on this call a buck, 5 years we have a housing glut in used homes. The reason why, as boomers begin to die off and their kids inherit the home, they either don't need the home or they sell it. And the acceleration of boomers leaving us, unfortunately, really accelerates starting in 5 years. Look at Phoenix, Arizona as a great example of a turn down in the housing market with an older population as an example of that. Boomers are living their lives in their homes rather than downsizing. Why? Because they accumulated so much wealth. Today, call it 70% of American assets are with people over the age of 65 and soon will be over the age of 70. And why that's powerful is they have very different spending habits. Why is the U.S. economy held up so well in this K-shaped economy, which is a real thing? because your house is worth double or triple more than what you expected it to be. You look at your investment account, double or triple more than what you expect it to be. Your cost of living are manageable because you can do things at home with the money that you've made now. So rather than downsize, you live your life in your home. That's created a housing issue. But we were right about being CLOs and mortgage backed. The
Hey,
other thing,
Phil, can I interrupt you real quick? So we have a lot of clients that we send this out to too. So can you explain like what you mean by the K-shaped economy?
so that's a great example of when people get kind of locked up in these weird, kind of goofy things we come up with. I didn't come up with it, somebody did. You think about the K, the 2/3 of the U.S. economy are that downward slope. That in the middle of the K, one bar goes up, one bar goes down. So the bar that's going down represents 2/3 of the U.S. population. That the folks in the middle class are pretty much fine the beginning of the downward turn, and those who are towards it make less money towards the bottom are not. And the reason why they're not is up until very recently, wages have been higher than the rate of inflation, and for the most part, they still are. Today's ADP number came out at 4.4%, but that's everybody combined. The point is, though, the costs that have accelerated since 2020 have punished that lower class. And if you look at their savings rate, you look at their default rate, you look at everything but mortgages, there is stress in those markets. Now, here's the key. The stress is back to where it was pre-pandemic. So you look at stress of people under $80,000 a year and credit card stress, their default rate of the last 90 days is about 4%, closing in on 5%. What's the historical average? 4%. Okay, so we're about 1% to 1.5% higher on a default rate for the bottom half of the K. But the reason why the bottom half of the K comes down to this. The top 1% in this country own basically 33% of American assets. Top 20% own almost everything. The bottom 50% only own 3% of American assets. Here's the problem with that. Here's your K. They don't own a house. They didn't have a big investment account. They didn't get this massive inflation that's happened since 2008. Let's not kid ourselves, everybody. When the federal government prints the upwards of $18 trillion and infuses it into the U.S. economy, where did that money go? Into assets. What are those assets? Homes, cars, investments. If you owned them, you own hard assets, you lifted. If you didn't, you didn't. So the bottom 50% increased their net worth by about $3 trillion. The top, about $28 trillion. It's a big number. So that disparity has created this K-shaped economy. Here's the key. Is it that different than any time in U.S. history? Yes. Significantly different? No. There's always been the wealthy and the ultra wealthy. It's the worst ever from the spread. But we've always had this gap. I would argue we're on the cusp of an economic miracle. For the pain we're dealing with right now, with 100 million people just hanging on, in 10 years, that pain is completely reversed. Why? Because $98 trillion moves from the boomer generation to every aspect of the next generation. Gen Z, Gen Y, Gen X, and it's going to come in the form of those assets. So you get this massive debt destruction. You got this massive movement of money. But until then, you need wages, back to where we started the conversation today, to stay above the rate of inflation. If they do, I'm not too worried about the K-shaped economy. And that's why gasoline below $3 a gallon nationwide is powerful. So I do think there's something to be said for them just hanging on. The other folks, that K going up, why are first-class seats harder to find than the seats in the back of the plane? Because all the boomers are flying first class. They're going to spend the millions you all as financial advisors have made them. That's what a K-shape is, and that's true. I mean, you look at the people with invested assets; it's quite incredible. Anybody who had a 401k, and here's the goofy part about the 401k. I don't think we all realize it, but that act in 1980 changed course corrected the future of American investments. Now that we find in the last 10 years, think every single day what happens. Money flows into the market because of the 401k phenomenon. And for those who are invested properly, they've done really well. Back to my 1 to 10%. Why do I think 1 to 10%? You don't have real stimulus by the federal government. You're not printing any more money. You do have it in the form of lower taxes, which you'd argue is going to balloon a deficit by about $300 billion, maybe, depending on where tax receipts go. But in fairness, you don't have an infrastructure bill. You don't have a bill, whatever you want, whatever the numerous bills over the last 20 years that pump money in the U.S. economy. So you don't have artificial stimulus, you get normal returns. Long answer to a short question, but a good one, Andrew. I appreciate it.
That was good. And I think once people inherit money, we see the inheritors tend to spend it more than what, and more consumption than what
I think that's right.
older people or boomers would have in place. So
I bet if we
yeah.
did it based on, I love demographics. I'm a huge fan of demographics. If you look at it based on age, it probably different spending habits across the age spectrum as well.
Yeah.
So that
No,
was
thanks.
housing was the big one. We saw the crypto markets trade in line with the Nasdaq and even not have the year we expected. We thought that was the case. We were very bullish on energy and AI going into the year, and that worked out. You all know that story. Where we as a money manager could have been better, we thought the last year would have given us a 12% rate of return on the S&P, came in a bit higher, almost 17. We did think U.S. markets, we thought U.S. economy would outpace European markets, and it did. But in fairness, U.S. international markets beat U.S. markets by 13%, depending on which market you look at. Small caps. We really like the small cap space, and they had an incredible run. I could show you a slide if we have time that, believe it or not, if you ask the average person, what was the winner, small caps or the S&P 500 after Liberation Day? Wes, the answer is?
Small caps, since you're putting me on the spot.
Small caps beat that. However, they sold off more going into Liberation Day, and they never beat them for the full year. But I think that small cap concept of 25% rates of return are quite fascinating for this year. And then we really thought that equities would normalize, and like I said, they did a bit better. Let's talk about 26. It's more exciting. Yeah. So we score ourselves, and I look at my 2025 scorecard, and it's kind of cool that we basically we put out 6 ideas last year. 3 out of 6 we nailed. The other 3 I'd say we were neutral. So we didn't get anything wrong last year. But there were 3 that we could have been more right on. This year I'll just rattle them off, and I'd love to dive into any of them, and maybe we'll go back to questions. But the first one, we think 26 is a defining year for AI. I know it's one of your questions later. And the reason why I think 26 is a defining year for AI, it's got to have productivity and revenue. If it doesn't produce productivity and revenue, we will get a hiccup in AI. And that's where you want to watch. And by the way, this is exactly why Micron, SanDisk are all doing better, because you can't just have the chip. You got to have the memory to store the data and the data center to store the memory. So that's why I like commodities in this year, because you need all this stuff. Think about Venezuela as a weird example of not having any infrastructure built in decades. The United States not having infrastructure built for our electricity in decades. You know, all this stuff that we're going to need tells me that AI is a defining year to see what are the other aspects of AI that drive this economy. And the second one is commodities. We think commodities will offer a really interesting way to bring beta down in the portfolio and capitalize on it. And I don't mean gold and silver. I think those are different, for goofy reasons, a totally different out of this aspect. But in the world of Dr. Copper, plastics, materials, plutonium, uranium, and so on, all these things I think are going to be finally this beginning of a super cycle in commodities. Maybe not as strong as 2001 to 2007, but emblematic of it as we go through it. And you can see it where you live. Look at your electrical bill. Electrical bill is not up because of data centers. That's only a piece of it. It's because of the weather of the last few years ripping things down. The necessary to have more efficient lines. The requirement for more power. We all want everything to your EV to your appliances at home, your phone, and so on. So I think commodities are my second one. The third one, the breadth of the market. That the breadth of the market, because based on where we started, valuations being expensive in ample asset classes. Think of it this way: you're cheaper on in small caps than you have been historically, and you're expecting 25% average earnings growth in small caps, especially if we get 2 rate cuts, versus high single digits for AI stocks. It's really hard to make a $5 trillion company a $10 trillion company. NVIDIA is a great company, but think of just the sheer amount of sales Microsoft and NVIDIA and on down the list have to produce to be able to continue to drive the market higher. Well, what does that mean? The Caterpillars down to the SanDisk of the world and all the small caps in between, I think make for a fascinating opportunity. So here's my bet. Remember that risk bet I said before? We have one opportunity where the U.S. economy grows at 3%, or the other side of it I didn't talk about, we contract. We don't grow. We see inflation push higher. The consumer weakens. We see unemployment tick a bit higher. Folks get tired of the high inflation. They've run out of their savings, and we just don't see that strength of the U.S. consumer. U.S. falls to a 1% GDP growth, not recessive, but 1% GDP growth. One of those 2 experiments happens over the next, this isn't long, 24 to 36 months. Over the next 12, 24, 36 months, You're going to find if this experiment based on this bill and regulation change either works to drive US GDP above 3% or we contract. So for us, we think it works. I'll give you an example. AstraZeneca. For those of you who have a family member who fights cancer or fought cancer, you've probably heard the name AstraZeneca. They're one of the bigger cancer companies in the world. Well, based on this ability to build a new factory in the United States, deduct the entire amount from your costs, they're building 2 factories in the United States, one in Maryland. $5 billion investment, 10,000 employees, all going to have wages in above $100,000 starting salary. That's a real thing. And we can go down this list and list a whole bunch of them. What if you could take U.S. manufacturing from 11% GDP to 12 or 13, maybe 15? So we think that has an impact. So we think U.S. GDP grows above historical trend of 2% this year. The next one, international markets. We think international markets continue to hold on. We've printed too much money. We have too much treasuries. Therefore, the dollar stays weaker. Even with a stronger U.S. economy, the rest of the world's doing well enough that we think this opportunity overseas because of valuations, earnings growth, and a flat to softer dollar gives you a chance to do well in international markets. I hate to say the word EM. Every time we say EM, you get it wrong. It always sounds great, and then it sucks in a portfolio because it starts off wonderful and blows up on you. We've made some money over the years. There's a lot of politics that play in the EM. I would suggest international development makes a lot of sense. I know it had a great year last year. We haven't owned it in over 10 years. We now have a 5% allocation and probably going higher. I mentioned bonds already. Bonds are beautiful. Have bonds in your portfolio, duration 6 years, maybe plus 7 years, somewhere in there. Case of a whopping 4 to 5% yield, maybe a little price appreciation. Enjoy it. It's risk-free money. You finally get bonds, not just insurance, but a moneymaker. And then, I have this what to watch area, and I think the what to watch stuff is fun. That one, I think we got to be careful about not getting too worked up about the job market. I think that a lower job market is going to become the new norm, adding $20,000, $30,000 a month. To the explosion of ETFs, just topical, that you're going to have clients who are going to come and go, what's this ETF thing if they're not already? The conversion of mutual funds to ETF, we think, is a new phenomenon, and it's going to really become kind of front and center, if you know what I mean. And the last one, and probably the biggest one, private equity, private credit, interval funds. You're going to be sick of those phrases by the end of this year. Why? Because whether it's the potential to have it in their 401k or just the necessity to have some alternative product as yields go a bit lower to add value to your portfolio. Those are things to think about. So let me stop there, and we can ask some more questions. I'd love to go into a deeper dive on data, but let me stop there. And if you want to do another question or two, how much time do we have, Andrew? I'm ramming along already.
We got till another 30
Got
minutes.
another 30
so
minutes.
I'm going to go ahead and we're going to do another poll question, if that's okay.
Okay.
We've
No,
got
they're
30
fun. I
minutes
think they're
still.
great.
So here's a question for everyone. How do you feel stocks are currently valued? Undervalued, equaling cheap, fairly valued, priced right, overvalued, expensive? We'll give another 30 seconds there to answer. We'll have you touch on this, and then we had a couple other follow-up questions to some of the generational transfers that you were talking about that we might touch on before.
So to save some time, I see most overvalued. As I mentioned already, I agree with you, except be careful. Don't paint with a broad brush. Overvalued in large cap growth. To some degree, some value stocks in large cap value, not overvalued in mid cap, and certainly not overvalued in small cap. So back to my broadening of the market, and by the way, not overvalued in international, not overvalued in emerging markets. You have opportunities. If you bet just on valuations, then you have opportunities in other places. But remember, valuations are not an entry point or an exit point. Valuations are simply a measuring stick as to when you add more or take away. Money management 101. Let me say that again. Valuations are not an entry point or an exit point. It's a management tool. I made some money. My value isn't stretched. Let me take some profits and pivot somewhere else. I don't want to leave NVIDIA, but why wouldn't I take 50% of my money and buy something else? I don't want to leave Microsoft. I'm going to take 25%. So it's okay to pay tax. I know we hate it, but reality is, go to your 1 year period, pay a little tax, or there's a lot of ways to mitigate that. But my point is use valuations as a metric to rebalance your portfolio, not an entry point, not an exit point, but a management tool. Sorry, I'm repeating.
No, it's a long-term portfolio, and getting diversified and rebalancing as we went is what we hold on to. So
exactly.
I'm going to pull this up real quick here. And I think we have some questions. Did you have anything else, Phil, that you really want to touch on at all?
I mean, if we have questions, you know me, I love questions. I do have backup data for my themes, but we don't have to go into that.
Yeah, let me pull this up here. But um, as we're pulling that up, I think like one of the things I'm looking for with AI is if we can get a robot to do my laundry. I think that's going to be peak civilization in my perspective. So I'm like, I'd be curious to see what the robots can do in the next few years. So
I want to give you. Let me give you a couple quick things
yeah,
that I thought folks should think about. So I talked about the unemployment market. The other thing I think you want to keep a close eye on is what happens with the tailwind of lower taxes.
yeah,
That's a kind of a goofy thing. It's out there. It's been discussed, and I don't mean corporate taxes. Individual tax rates on Social Security. There's some states that are pushing back on not. They're still going to tax tips and Social Security. Remember, states have their own taxation, and depending on where you live. But at the federal level, the no tax on tips, Social Security, and most importantly, the SALT tax. I live in New Jersey. Having it go to $40,000 is a big deal for me from 10 to 40. You know, that does change the narrative. So when you think about the health of the U.S. economy, there's a double-edged sword here. To Andrew's point earlier, you know, you're basically decreasing your tax base, but at the same token, you're empowering your U.S. consumer. So that'll be a fun kind of narrative to see how that plays out over the next few months, and is in fact it more substantive that people are paying less in taxes or less. By the way, to the K-shaped economy, just for fun, I think you all know this. The top 1% pay 40% of U.S. taxes. The top 20% pay almost 89% of U.S. taxes. The bottom 50% pay no U.S. taxes. So, you know, there is two ways to look at that story. And I know everyone knows that story, but I think it's helpful to reiterate some of that stuff. Did you get any questions, Wes? We can hit.
got some questions. Yeah,
Yes.
so the one question I think you mentioned about the housing market. One person asked, did you say that the housing market will collapse once the boomers pass away?
No,
And
have a glut. Have a glut. Collapses because you've now used, like we had, over leverage in the system. You wouldn't collapse, but you'll see prices correct, flatten to correct depending on the market. You know, for example, in New York City right now, the average. This is why probably there was a kind of unusual election recently, that we have the average. Just for fun, what do you think a one bedroom in Midtown Manhattan costs to rent? If you had to guess.
$5,000.
Yeah, you're right on. $5,000. A two bedroom, you know, 7 6 7 grand. I mean, it's insane.
Wow.
So you have this scenario nationwide where the affordability is through the roof. And as the boomers exit, the millennials have a choice to leave a multifamily where they're probably living. I bet you have multifamily explosion everywhere where you live. That's the byproduct of this. And go into a house. Where's the bust? Multifamily. So a glut in traditional second homes, especially location, but a bust in multifamily. I'd be very careful if you're in a long-term multifamily fund that's illiquid. I wouldn't want to be in it in 5 years from
Yeah. And I think back to your point about the K-shaped economy and the wealth dispersion, I think you're seeing things like with the New York election playing out because of that too.
now.
So
Exactly. This year, 2025, we saw 1.7 trillion move from the boomer to the next. Every single year, it's going to double.
yeah,
That's pretty cool. So this year, 3 trillion will move. That's a lot of money. 3 trillion, and then 6 trillion, and then on from there. You know, so
yeah.
it's quite a bit of money.
Uh, so the next question we had was, is there a large transfer of assets from the boomer generation? I've heard of a disproportionate amount of wealth is going towards healthcare. I guess from older people, is that backed by data? Like, are people spending down their assets, I guess, is the question, towards healthcare before it passes?
Remember, most seniors are on Medicaid and Medicare, so they get quite a bit of assistance there, depending on what supplement they have, obviously. But I think that's a fair question, except I don't think they can outspend their assets based on the size of the boomer population and the amount of wealth they've created. You're talking the boomers have around $150 trillion. I mean,
Yeah.
you know, 70%. We're worth 200 trillion as a country today. They've got about 150. Now, why I say it's 100 trillion going in motion, that other 50 trillion probably gets spent somewhere. Some of it's healthcare, some of it's travel, some of it's whatever, donations, charity, so on. But moving from one generation to the next, I think, is a big part of it.
Yeah. Wesley, I think you got some crypto questions. You want to jump in on the?
Yeah, we've got essentially two. One is an overview. How do you see crypto playing out in the next 12 to 36 months? And then I just had another general question that came in, just thoughts on crypto and gold. So if you
Separate
want to
them.
combine those
They
two,
become
separate them, but
they become
figured
very
I'd
good.
ask at the same time.
The crypto market, exemplary by IBIT, just go look at IBIT, tells you everything you need to know. What happened with the crypto market became a risk on, risk off trade. And the reality is, I think everyone's grasping that it'll never be a currency. As much as everyone wants it to be, it won't. Will there be a future in stable coins? Absolutely. I think what Wyoming is doing, if you haven't studied, we did a white paper on it. The Wyoming stable coin, which is backed by the U.S. Treasury, which allows interstate commerce in a blink of an eye, fascinating. The tokenization of the building in New York City, that anyone you take 1,000 tokens represent a building, the digitization of our economy, fascinating and to come. But to think that the crypto market's ever going to be a currency, I think, is a fool's errand. The United States is never going to give up its ability to create and redeem its own currency, and neither will the rest of the world. However, there is that other side of why is gold up and why was crypto up so much before it had this run? I think there was this anti-fiat currency moment that really fueled the growth of crypto. And today you have a scenario where I think that's a bit tired. You're waiting for the next leg higher. There is already commerce using crypto. It's not necessarily Bitcoin, because you know what North Korea's number 2 revenue line item is? Number 1 is the manufacturing of defense equipment and our agriculture. I'll group them together because we don't really know. But you know what their second number revenue line is? It's the theft of crypto, theft of Bitcoin. Wrap your head around that for a minute. It's insane. So I think that crypto, if you want to be in that space, be in the exchanges, be in the people manufacturing it, be in the regulatory arm supporting it. I don't know. I want to make a bet on a particular currency. I think that's a little too speculative. On the flip side, but by the way, if you want to buy IBIT down there because it's down, 40%, and you want to gamble, I bet that gets the 40 back. I just don't see it doubling after that. Why? Because there's just not enough euphoria around it anymore. Now, if you ask me about gold, I would say, if you had asked me this time last year, I said, why would you buy gold? Stupid idea. Inflation's coming down. Why? I would have been 100% wrong. In fact, I don't own it, so I am 100% wrong. But the reality is gold succeeded not because of what we're used to. We're used to gold going higher in inflationary periods and in periods of high leverage as an anti-currency, anti-leverage investment. What happened in the last 2 years, finally getting back to its all-time high of the 70s, was it became an anti-fiat currency issue, meaning there's just too much dollars floating, or too much currency floating around the world that's backed by weak economies. Where's our alternative? Gold. And then we had a huge buying season in India and in China. Post-pandemic, everyone wanted to go out and get married and buy gold in those countries. Will this continue? I struggle to see it continue the same way I struggle to see it be up 60% this year. Why is silver up 160%? We don't really use silver in anything. There's some manufacturing. You don't use gold in anything. You can't eat it. It doesn't make anything. It's just a perception of value. So here's why I don't want to buy it. It's not because I don't think it can go higher. It probably can. It probably will. But it's simply a perception of value. And you're perceiving that the U.S. economy is going to contract. France is going to fall into the ocean. And it looks like it might actually fall in bad shape. That the rest of the world will really go into a significant slowdown, and gold wins in that scenario. I'm struggling with that concept. And the reason why, I think we're past the pandemic. I think you're in a basis of a global growth cycle. And if you get a global growth, think about it. Other than a war with Russia and Ukraine, which has kind of gotten goofy in a lot of ways, it's not affecting economics. I'm not talking people. Economics isn't really affecting economics. Where do you have a slowdown in the world today? You really don't have one, other than France. Japan is not doing great, but they're not doing worse. So I think we get this kind of cycle of growth that's, global growth around 2.5%, maybe 1.8 to 2.2. In that scenario, gold gets its ass kicked. So it's the perception of value. But I was wrong. I would have said probably the same thing to you last time. By the way, I don't love that it's all synthetic too.
I've never heard you say you were wrong before, so that's a nice statement. So yeah,
I'm wrong a lot, buddy. So I should say it more often. But anyway, that's my answer.
No,
for those of you
one thing I was going to say on crypto, one thing I was going to say on crypto is the interesting thing with stable coins, it actually creates a lot of demand for U.S. Treasuries too, like as part
Exactly.
of the stable
That's
coin.
exactly
Yeah,
that's exactly right. You're spot on. But think about it. You get income off the stable coin because of the treasury income. The money goes back into the state and allows for quick commerce. That part's cool. And it's
yeah,
safe because it's based on treasuries. It can't be stolen. So that part I really like. The other part, not so much. Gold,
yeah.
for those who own it and you're willing to take here's what I'd say. One last thing on gold. I like commodities. Why? There's a need for metals. And if you happen to be in a commodity fund, and I could recommend one that has a little piece of gold in it, awesome. That's how I would do it. I wouldn't do it as a single bet or silver or platinum.
Sounds good.
Awesome.
I do have a slight pivot question. I think you kind of touched on it a little bit earlier, but are you concerned about Fed independence with Powell probably being, well, I'm pretty sure he's on his way out here later this year, and who
He could
then,
become a governor if he wants to.
true, true, yeah,
No, I'm not. I'm really not. I look. So I'm 58 years old. I grew up with inflation at 4%, unemployment at 6%, and the Fed funds rate around 4. Things are great. They're not good. They're great. We're at 4.3% unemployment, inflation at whatever you want to. We'll pick the metric you want. 275, 3%. Interest rates, go get a mortgage right now. What, 6%? It used to be double or triple that. So I'm not too worried about the Fed. I would say this: if you get a new Fed governor, Kevin Hassett's probably the guy, and he tries to convince the other governors to cut 50 basis points on the front of the curve. I do think they're a bit high. I was on Fox a couple weeks ago on the last Fed cut. Having the front of the curve at 350 with inflation at 275 and a natural rate, which is where you don't increase or decrease lending, it's probably 375. I'm sorry, 275. If you look at where the front end of inflation is, you look at where the field curve is. I mean, there's so much liquidity in the system. I think it's all bullshit, to be honest with you. I'm going to take a different approach. I think all this nonsense around Fed cutting is bullshit. The only person that hurts is the poor little guy who has an auto loan, a home equity loan, a credit card. That's what's hurting. Is it going to really spur so much borrowing when we cut 50 basis points? No. So I don't care they get a new governor and cut 50 basis points. You know what's going to help? The poor bastard, poor person who got some debt. So student loans. So I'd be okay with a governor coming in and taking 50 basis points out. Get us to 3. Let the front end of the curve fall to 3. Let inflation get stuck at 275, 250. And let's stop talking about this, for God's sakes. Let's get the Fed out. I'm more excited about them getting out of the way. Stop talking about it.
It's interesting to see rates go from 3% to 6% and people who are not used to that ever. When you talk to older clients that had mortgages at 18%, 15% in the early 80s, it's like, deal. I think it's a big jump to go from 3% to double to 6%.
It's 100% increase, and that hurt.
Historically speaking,
but I think at this point, stop worrying about the Fed. Ultimately, I think we're in a deflationary world. Ultimately, because AI is deflationary, technology is deflationary, and demographics are deflationary. There's only one country in the world growing population, India. That's it. The expectations of breaking 10 billion people on the planet, probably never going to happen. I mean, it seems like every country in the world. Look at us. We were great demographics. Now we're starting to turn down. We stopped taking in immigrants. I'm a kid of immigrants. My mom and dad from Italy. I think it's a terrible idea. I would argue legal. I don't want to get into that fight. That's just personal. But bringing in 1.5 million people a year, because immigrants have babies and they buy houses and they come and they do jobs that most people don't want to do, and they are accretive to the workforce. That's why it's part of the American capitalistic system. I think you got to figure that out. But demographics are deflationary, and I think ultimately we're in a deflationary world. So having lower rates for people who want to borrow some money, I think that's okay.
So I think it actually gets into one of the questions too. So it says, for those who are not owning real estate, can you please comment on it if it's likely the best way to use to buy a house or allow the supply to increase due to demographics in order to get affordable housing? Like, I know this is a little more personal question, but like, where do you see housing prices coming down because of the glut, or?
I do. No, I think a 20% correction in housing prices would be necessary and very probable, especially in an area where there's an older population, Florida, Arizona, Colorado. I think those are areas where you could have a real impact. High demand areas around Chicago, around New York City, New Jersey, parts of California, I think those are more difficult. But all you need to know is look at your demographics where you live. If you're there's demographic websites all that federal government has a great one. Just look at your population demographics. Are people coming? If you live in Florida where the people moving in every single day and you happen to be one of those areas, good luck. You're not going to get a break for a while. But if you're in Florida where there's a lot of older folks, 5 years, you will get a break. So I think you have this problem where the cost of building the homes has skyrocketed because of the last 5 years of inflation. And I'll be a bit provocative. I know people want to hear it. I like what happened in inflation in some regard. It's an economic miracle that wages have beaten the rate of inflation for 8 out of the last 10 years. I don't care what administration was in power. When wages are higher than inflation, it means the folks who make less than 100 grand a year. Remember, it wasn't long ago. The average salary in the United States was 45 grand. It's almost 80 now. It almost doubled, depending on what sector you're in, 70 to 80 grand. Holy smokes, that's great. That means that we can live better lives and buy more stuff and maybe, do whatever they want with themselves. So I think that wages above the rate of inflation is very powerful stimulant for the U.S. economy, but it means you're probably going to have to pay a bit more. That part sucks. I get it. However, from the housing market, it's a little bit like the beef market. Post 2008, all the builders got smart and said, wait, let me think about this. I can build less homes and make the same revenue. Why? Because they didn't want to have bubbles anymore. They were tired of the boom. Remember the boom and bust cycles in real estate? We haven't had one in decades. That was normal in the 70s, in the 80s, in the 90s. It stopped. Why? Because you're not building enough. You're barely building enough homes to replace scrappage homes that just wear out. And so the builders do is they kept prices very high and don't let a crisis go to waste. They raise wages and prices even higher during this bout of inflation. Same thing for beef. What do the cattle ranchers do? Cattle ranchers said, wait a minute, during the pandemic, we're eating less beef. We raise less cattle. Then they raise the price of beef. They blame it on a fly out of Mexico and lack of rain in Texas. I think that's the biggest crock ever. Why? Because I can have less cattle, less people, charge more per pound, and make the same money. So why do you go to Argentina for beef? Because U.S. ranchers don't want to raise enough cattle. So what do you got to do in the housing market? Wait for people to die off or build more homes. So you're not going to build more homes right now because that's a bit of a challenge. I just think it's a process of, over time, this thing will right itself. For today, go to multifamily, pay the freight, but be prepared to sell it when you get an opportunity. And it is location, location, location. Go to an area in the country where there's not a significant older population. You won't have this problem.
An interesting question on, we talked about crypto and people buying crypto, but like sports gambling. Any thoughts on the increase in sports gambling, taking out male wealth from millennials and other generations? Like I see it, I think it's a problem, but
I'll take that question a different way. Have you all looked at the prediction markets, these prediction market websites?
Yeah, Polymarket. Yeah.
Oh my God. What's that one called that's really popular? I always forget the name.
Polymarket.
Kalshi.
Kashi.
Kashi? Okay.
I mean, this stuff is unregulated. I think it's terrible. The concept is brilliant. But for the love of God, we got to put regulations on this. People are going to lose their shirt. I mean, you can bet on Mondami being like impeached in like 3 months or something. I mean, some of these crazy things. And it's anything. So that means you've made gambling a part of everybody's daily life without regulations on a prediction market or some of the sports betting. I think it's dangerous. And what it even makes it more worrisome for me is the stock market is not gambling. And there are people who perceive that with the kind of the gamification that happened with GameStop and AMC and this kind of meme stock craze. That's not what this is. It's the greatest wealth engine in the world if you do it right. And I think those areas are fascinating, but I really hope there's some education around the right amount of money you should apply there and the regulation on what should happen. Otherwise, we're going to see people losing a lot of money. Those prediction markets I can't believe it. I mean, it's anything you want to bet on.
Yeah.
We've got one more poll question here before.
Oh, let me, and we got a couple of things here. I saw one more too. Somebody asked if we're taking any new clients too. So we are taking new clients. Phil helps manage like some of our smaller portfolios. And so like Phil's worked with us for years. And so they were asking if Phil's taking new clients, but like, if you have any questions about financial planning.
I work for them, everybody.
Yeah.
They're the boss. I'm just a money manager. I'm a guy who does this. I get that. For those who don't know me, I manage about $8 billion on discretion, oversee about $800 billion. I'm the CIO of a company called Osaic and the chief strategist, as well as the guy's been doing this for 36 years now. So this is what I do all day long. But I work for Wes and Andrew. They are your local financial advisor. They're the ones you get to know. They're the ones who can build a plan for you and potentially hire us as maybe one of the investments in the portfolio. So Just
Appreciate that.
understand, they asked me to join it because I do this all day, every day.
Yeah.
And I do love it. I have a lot of
So
fun.
yeah, and we appreciate you too. Last poll question was, what do you think the likelihood is of a recession in 2026, which I think you kind of alluded to early
Yeah,
on, and
the numbers
we're
are tight.
seeing,
Yeah.
yeah, they are. It's kind of spread out. Like,
I love that. Find out from
let's
the folks why, because that bottom, call it what's that, about 110
bottom
people,
5%.
115
So
people. Yeah.
yeah,
I wonder why, and I guess their concern is inflation. That ultimately they feel like inflation could lead to that, and I don't disagree with them. But you got to look at inflation as a whole. Remember when egg prices were the thing? They're not anymore. When gas was the thing, it's not anymore. Your electrical bill is for sure. But if you look at what happened with
Tariffs.
tariffs, and notice I haven't hit
Yeah.
on tariffs. Tariffs have been a non-event, everybody. It could become an event in the second half of 26. And that's because there were a lot of things bought in 25 that have now burnt their way through. As supplies get replenished into 26, inventories are at some of the lowest levels we've seen in decades. As new stuff gets bought, what happens? But for example, my mom and dad are from Italy. I was really concerned about tariffs on Italian pasta because Italian pasta is only wheat, water, and maybe or maybe not eggs. None of all these goofy ingredients when you look at American pasta. So buy Italian pasta; it's better for you. You don't have gut issues. Trust me, I know what I'm talking about. But they were going to have a 90% tariff on Italian pasta. Well, guess what? It's now 0. Why? Because finally the administration woke up and said there's certain things we don't make that we got to fix. The best example is Vietnam. And look at Vietnam. Vietnam came to the table early with a 15 to 20% tariff, depending on what it is. And they accepted the tariffs that were going to be placed on existing goods. But what did Vietnam do? They picked up all kinds of product manufacturing from China because China's refusing to come to agreement. So the movement of manufacturing around the world, U.S. good production is up, and we're seeing more Americans buy U.S. made product than foreign product. Tariff revenue is probably going to be 300 billion to 400 billion. So it's a little bit of money, but not going to move the needle on a deficit a little bit. But ultimately, it looks like the tariffs is going to settle in about 10 to 15% in mass for the whole world. And so far, 1/3 is being borne by the manufacturer of that product, 1/3 by the distributor. So think about China as making my shirt, Macy's selling the shirt, and then me as the consumer buying it. I'm meeting about 1/3. So all of us were having about a $600, $800 more per year in the form of tariffs. So for those who are worried about tariffs, it's not recessionary. If you're worried about inflation, there's still some of that in the system. Here's the hard part, everybody. The prices are never going back to where they were. Anyone thinks they are, that's just not how it works. Will they continue to go higher? No, I don't think they do. And that's the magic of this. But be okay with a little bit of it. Why? Because it means people are, as long as wages stay above the rate of inflation, just today, ADP, which measures private sector payrolls, says the average wage increase over the last year is 4.4%. I mentioned this already. Inflation's right around 275 to 3. That's 1.25% higher than inflation. Boom. That's a win. That's why we don't recess. Good question.
Yeah.
great.
I think we're gonna start to wrap up here, Phil. But one question. So somebody asked, as financial advisors or wealth managers, in trying to I think the question is like when we're working with clients, what's the best way to set expectations for returns in regards to portfolios? We look at the risk of a portfolio, the allocation of stocks and bonds, what we think stocks are going to perform for the long term, and what bonds are going to perform for the long term, and what a client has in regards to saved up, what they have for debt, what they're like when they're going to retire, what goals they have. So it's not a perfect answer, but it's individual to the client and based on the portfolio and the risk they want to take on the client. So if anybody has any questions or if anyone wants to reach out to Wesley or I to just have a no obligation call, we're happy to do that and just talk through some scenarios, and everything's confidential. So I think we're getting close to the end of the hour. So I probably should wrap up here, Phil, but I just want to say thank you for joining us, and we always appreciate your time. And Wesley, did you have any final thoughts at all before we start to wrap up here?
No, I just wanted to say thank you as well. Really appreciate you taking the time. I know you get pulled in a lot of directions and stuff, and so sorry we took you away from TV to spend time with us. But
That's okay. My pleasure. I appreciate
anyone
you.
else that Yeah, and anyone else that has questions, if we didn't get to them today, there will be a survey at the end when you disconnect. So feel free to add in any comments or questions there, and we will follow up with you. And on that note,
We
wish
do
you a
we, we
great.
do have a large team of financial advisors. So if anybody doesn't know who to connect with, feel free to reach out to me or Wesley, and we can connect you with somebody and just answer any questions you might have. But like, yeah, always feel free to reach out. So we're happy to have. But Phil, thank you again. So
My pleasure. Take
Great.
care, everybody. Have a great new
Thanks,
year.
everyone.
happy New Year.
All right.
See ya.
Bye-bye.